4.21. From the following table of financial ratios of RT Textiles Limited, comment on various ratios given at the end. So we just need to comment on the ratios. Liquidity ratios are given, including current ratio, quick ratio, receivable turnover ratio, inventory turnover, receivable collection period. Operating profitability is given, financial decision is given, and return on equity is given. All right. Comment on the following aspects of RT Textile Limited. First, on liquidity. So let us read and interpret the liquidity ratios. What was current ratio in 2017? 2.2. What is it in 2018? 2.5. So liquidity position has increased. What is the industry average? Is 2.5. So 2.5 is the minimum requirement as far as industry is concerned. High level of current assets are required to pay off your liability. And in 2018, we are meeting the average, and also current ratio has increased as compared to previous year. So it is good sign for us. Even same for quick ratio. Yes, it is greater than industry average, but it is slowly and gradually increasing. Very high current ratio or liquidity ratio as compared to industry is not good, because as we have learned, risk versus return. As you increase your current ratios, your profitability will decrease. See, we can see even from this, your profitability has decreased because you have increased your current ratio. Receivable turnover ratio was 6, even industry average is 6, so no comment on it. Inventory turnover ratio was 9, now it is 10. So now the inventory has also become fast moving, and industry average is 6. So it is good for us. We are rotating our inventory as compared to industry, practically doubled. The industry is turnovering in a year 6 times. We are turnovering in a year 10 times our inventory. Receivable collection period is 86 days. So which is near about average industry standard, and it has somewhat decreased as compared to previous year. Let us go to operating profits. In 2017, it was 25%. Now it has reduced to 22%. So as far as profitability, income is concerned, it is not a good thing. Still, we are above the industry average. So that is good for us. Operating profit margin was 19%, which is 10% of industry average. So we are maintaining our operating profit margin at 19%, which where the industry average is 10%. So we are performing good over here. Financing decision, debt ratio was 49%. We have reduced 1% of debt in a year, which is, we cannot say it is a good sign. Try to understand, our rate of return is very high as compared to industry average. Now our R will be greater than KD. Here KD is not given, and we might be having a favorable leverage. So increasing the debt proportion might be helpful to us rather than decreasing the debt proportion. Return on equity was 24%, has increased by 1%, 25%, where the industry standard is 15%. So we are giving a very good return on equity to our equity shareholders. We have comment on return to shareholders and even financing.